Ladies and gentlemen, good day and welcome to Popular Vehicles and Services Limited Q3 and 9 months FY2026 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of the future performance and it may involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Naveen Philip, MD and promoter from Popular Services and Vehicle Limited. Thank you and over to you, sir.
Thank you, Parag. Good afternoon, everyone, and thank you for joining us today. Over the past few quarters, PVSL has navigated a challenging yet evolving operating environment with discipline and clear long-term strategic focus. I am pleased to share that the Q3 FY26 has emerged as our strongest performing quarter after nearly 1.5 years of muted performance. The quarter marks a clear inflection point for the business, supported by a meaningful improvement in customer sentiment and a broad-based recovery in demand across key segments. Customer sentiment improved significantly during the quarter, particularly following the recent GST reforms, which acted as a strong catalyst for demand revival. This was most evident in the entry-level passenger vehicle segment, where volumes rebounded sharply after a prolonged period of inventory overhang. Post-GST rationalization, entry-level passenger vehicles volumes grew by over 35% year-on-year in Q3 FY26, reversing the weakness witnessed over the past 5-6 quarters. This recovery was complemented by continued strength in the premium vehicle segment, which delivered volume growth of 30% YOY, reflecting resilient discretionary demand and improved product offerings from the OEMs. Encouragingly, the commercial vehicle segment also showed early signs of a turnaround, with volumes growing by over 52% YOY in Q3 FY26. With the Indian economy continuing to grow at a healthy pace and the Union Budget's strong emphasis on infrastructure development, we remain optimistic about a sustained recovery in CV demand over the medium term. In the EV two-wheeler segment, penetration levels continued to rise. Ather gained further market share during the quarter, translating into a strong growth in both volumes and revenues for us, reinforcing our positioning in this fast-growing segment. That said, luxury car volumes, that's namely JLR, were temporarily impacted due to cyber attack at one of our OEM partners, which disrupted operations during the quarter. I'm happy to share that the issue has now been fully resolved. Operations have normalized and we expect a pickup in Q4 and the coming quarters. Service business witnessed some softness during the quarter, largely reflecting the lag effect of lower new vehicle sales in the earlier periods, as vehicles typically enter the service cycle after 1 or 2 years. However, our continued focus on higher margin services such as collision repair helped partially offset the impact of lower volumes. As a result, service top line increased marginally by 1% YOY. With the recent recovery in vehicle sales, we expect service volumes to improve steadily over the coming few years. Operational performance. From an operational standpoint, inventory utilization and execution efficiency improved sequentially. This was supported by the GST reform-led demand recovery, particularly in entry-level vehicles. The exit of 2 OEM relationships that freed up management bandwidth and sustained cost rationalization initiatives. Our continued emphasis on operational excellence and a balanced mix of value and volume-led growth resulted in meaningful reduction in inventory levels. The rolling 3-month average inventory currently stands at 22 days, and the new vehicle inventory is at 19 days, reflecting improved supply-demand alignment and disciplined working capital management. Importantly, our balance sheet remains robust, providing flexibility to fund growth initiatives, manage cyclicality, and pursue selective expansion opportunities without compromising financial prudence. Strategically, PVSL remains committed to diversification across customers, geographies, and product applications. We continue to deepen relationships with our existing OEM partners while investing in technology, automation, and process improvements to position the business for sustained growth. During the period, we strengthened our luxury portfolio with the addition of Audi dealership, acquiring an existing Audi dealership covering Telangana and Andhra Pradesh. This marks the beginning of the new OEM relationship with one of the world's leading premium automobile manufacturers. We believe that the luxury and the ultra-luxury segment in India remains significantly underpenetrated, and as they progress towards becoming the world's third largest economy, rising income levels and improving purchasing power present a compelling long-term opportunity. In addition, we entered into an agreement to become the authorized distributor for Balakrishna Industries Limited (BKT) in Kerala and Karnataka, covering their two-wheeler and passenger car radial segments which they are just entering into. This represents an important expansion of our spare parts business and provides an additional growth avenue beyond vehicle retailing. We also established SpareX Digi Solutions Private Limited, an e-commerce platform for spare parts and accessories, as a step-down subsidiary under our wholly owned subsidiary Popular Mega Motors. This initiative further strengthens our omni-channel presence and spare parts ecosystem. All these initiatives align with our strategy of segment, geographic, and revenue diversification while participating in India's long-term structural growth story. We believe that the expansion undertaken over the last 8 to 10 months positions us well to drive strong growth momentum ahead. Our focus will now shift towards consolidating and stabilizing the recently acquired businesses and fully integrating them with our existing operations. We will continue to pursue organic growth opportunities wherever there is potential to expand our offerings for customers, while adopting a measured approach to further acquisitions rather than pursuing them aggressively. With this strategy, we expect to deliver a healthy and sustainable growth going forward. Financial performance. Financially, 9 months FY26 was characterized by steady operational execution amid external headwinds. Demand softness across key markets and sustained pricing pressures impacted revenue growth during the period April to mid-August. Despite these challenges, we remain firmly focused on cost control, working capital discipline, and balance sheet strength. This disciplined approach allowed us to place the business on a stronger footing, enabling us to effectively leverage the improving external environment following GST reforms. New vehicle volume performance. 16,023 units sold in Q3 FY26 vis-a-vis 11,151 in Q3 FY25, a 44% increase YOY, and a 23% increase quarter-on-quarter from 13,012 units in Q2 FY26. For 9 months FY26, we sold 38,567 units, an increase of 14% from 33,717 units in 9 months FY25. The growth in volumes during the latter part of the quarter and across Q3 FY26 helped us preserve margins despite taking provisions towards cess due to prevailing uncertainties. As a prudent measure, we have absorbed the impact in the current and the previous period. Excluding this provision, EBITDA margins would have been approximately higher by 20 basis points. Excuse me. Further, the acquisitions completed during 9 months FY26, along with ongoing organic network expansion, will have a near-term impact on our cost structure during the current financial year and may exert some pressure on margins. The full revenue benefits from these initiatives are expected to accrue from FY27 onwards. Accordingly, we expect EBITDA margins to normalize towards 5% range in FY27 as scale begins to kick in. At the PBT level, the overall India's impact amounts to rupees 4 crore from acquisitions and around 3.5 crore arising from compensation scheme from Q3. In addition, there's an additional impact of 1.6 crores due to the new labor code. For 9 months FY26, after adjusting the divestment gain cess provision and the impact of new labor code and acquisition-linked depreciation, index adjustments, and initial transitional operating losses, PBT would be approximately 3.4 crores. Outlook. FY26 outlook. Looking ahead, while the worst appears to be behind us, recent GST reforms, implementation of the revised 8th pay commission and income tax cuts announced last year have supported a gradual recovery in consumer sentiment and improved traction in entry-level vehicles, a segment that had been a drag over the past 2 years. This, coupled with easing inventory levels and lower discounting, is supportive of margin recovery. We expect Q4 FY26 to outperform Q3 FY26, enabling FY26 to close with mid-teens growth vis-à-vis FY25, compared to our initial expectation of a single-digit growth. FY27 outlook. Demand indicators are turning decisively positive, with customer inquiries and footfalls showing strong momentum. Our organic and inorganic initiatives executed over the past 12 quarters are expected to further strengthen the business model. The service business is expected to rebound, driven by expansion into newer geographies and recent acquisitions. Services remain structurally resilient, with organized players gaining market share. While revenue remains relatively stable due to higher value services, we expect double-digit service volume growth from FY27. Additionally, our focus on scaling other high-margin verticals, particularly the spare parts business alongside services, should contribute meaningfully to both revenue and profitability. With continued emphasis on internal efficiency improvements, we expect these initiatives to translate into a high double-digit top-line growth in FY27, with an EBITDA margin target of 5% and PAT approaching FY24 levels. To conclude, PBSL is confident in its strategy, prepared for the upcycle, and committed to emerging stronger and more resilient in the years ahead. The underlying demand environment is clearly improving. With healthier inventory levels, lower discounting, continued network expansion, and several new model launches lined up by OEMs, we believe the company is well positioned to sustain volume growth momentum and deliver improved financial performance in the coming quarters. Our focus remains clear: driving profitable growth, enhancing return ratios, and creating long-term value for stakeholders. Thank you. That's all from my side. I will now hand over to Abraham for further financial updates. Over to you, Abraham.
Thank you, Naveen, and good afternoon, everyone. I will take you all through the company's operational and financial performance for Q3 and 9 months ending FY26. Before I start, please note that Honda and Piaggio volume and revenue was till August 2025 only. Q3 FY26 key highlights in passenger vehicles. New vehicle volume stood at 10,428 units, up 38% year-on-year from 7,571 units in Q3 FY25. Total income from the segment stood at rupees 749 crores, up 31% from 573 crores in Q3 FY25. Service volume stood at 1,72,495 units, down 19% year-on-year from 2,11,665 in Q3 FY25. Total income from the segment stood at 151 crores, down 2% from 154 crores in Q3 FY25. Commercial vehicles. New vehicle volume stood at 3,555 units, up 52% year-on-year from 2,340 units in Q3 FY25. Total income from the segment stood at 604 crores, up 66% from 363 crores in Q3 FY25. Service volume stood at 53,949 units, up 17% year-on-year from 45,962 units in Q3 of FY25. Total income from the segment stood at 94 crores, up 8% from 87 crores in Q3 FY25. EV. New vehicle volume stood at 2,040 units, up 65% year-on-year from 1,240 units Q3 FY25. Total income from the segment stood at rupees 34 crores, up 50% from rupees 23 crores in Q3 FY25. Service volume stood at 10,200 units, up 80% year-on-year from 5,660 in Q3 of FY25. Total income from the segment stood at approximately 2 crores in Q3 of FY26. Moving to the financial performance. Our total income for the quarter stood at 1,791.8 crores, up 30.9% year-on-year from 1,368.6 crores in Q3 FY25 and up 16.8% quarter-on-quarter from 1,534.6 crores in Q2 of FY26. The impairment losses reduced to 0.2 crores from 1.7 crores in Q2 of FY26, driven by lower debtor provisions resulting from improved collections. The employee cost during this period increased in the quarter, primarily due to the integration of the Telangana and Punjab operations. EBITDA stood at 58.2 crores, up 68.5% year-on-year from 34.6 crores in Q3 FY25 and up 17.8% quarter-on-quarter from 49.4 crores in Q2 FY26. EBITDA margin stood at 3.3% from Q3 FY26. Other expenses include a cess provision of 3.5 crores in Q3 FY26 and 3.6 crores from Q2 FY26. Adjusted EBITDA comes at rupees 61.7 crores in Q3 FY26, up 78.6% year-on-year and up 16.4% quarter-on-quarter. Adjusted EBITDA margin stands at 3.4% from Q3 FY26. We recorded an impact of rupees 1.6 crores as an exceptional item due to the new labor code in Q3 FY26. There was a PAT of 0.7 crores versus loss of 9.8 crores in Q3 FY25 and PAT of 0.6 crores in Q2 of FY26. 9 months ending December FY26 financial performance. Our total income stood at 4,642.3 crores, up 10.9% year-on-year from 4,185.4 crores in 9 months FY25. EBITDA was at 145.9 crores vis-a-vis 145.7 crores in 9 months FY25, an increase of 0.2% year-on-year. EBITDA margin stands at 3.1% for 9 months FY26. Adjusted EBITDA comes at rupees 153 crores in 9 months FY26, up 5% year-on-year. Adjusted margin stands at 3.3% from 9 months FY26. There was a loss of 7.5 crores versus PAT of 3.3 crores in 9 months FY25. As Naveen also mentioned, for 9 months FY26, after adjusting for the divestment gain, cess provisions, the impact of the new labor code, acquisition-linked depreciation, index adjustments, and initial transition operation losses, the profit before tax would be 3.4 crores. The other updates, credit rating update. India Ratings and Research Private Limited has affirmed the ratings of the bank loan facilities for Popular Auto Dealers Private Limited, a wholly owned subsidiary, at A- stable. Awards and recognition. Popular Mega Motors India Private Limited, company's wholly owned subsidiary, received multiple accolades from Tata Motors for the South India region for Q3 FY26. They were the highest volume growth, Magic and Winger winner, Customer Support winner, Customer Success Center winner, CPSC SCBPU winner. Popular Auto Dealers Private Limited, company's wholly owned subsidiary, has been recognized and inducted into the prestigious MSDA Club for outstanding performance and also received multiple accolades from MGP Parts Distributor Meet 2025 of the OEM. Product Champion in Accessories, MSGA AC Gas, All India Highest MSGA Retail Award, Independent Workshop Retail Growth Award, and All India Highest Parts Retail Growth Award. The state-wise revenue breakup for Q3 FY26 is Kerala at 55%, Tamil Nadu 26%, Karnataka 11%, Maharashtra 5%, Punjab 2%, and Telangana at 1%. That is it from my side. Now I would like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Preet Pitani from InCred AMC. Please go ahead.
Thank you for the opportunity. Sir, I would like to ask about the debt currently which we have. Like September, we have reported around 1,100 crores of debt. What would be the debt as on December 25? And do we expect it to further rise or will it stay at the same levels? And also, if you can mention something about inventory days across products.
Okay. So to start on the debt position that we're looking at, the approximate debt that we have in the balance sheet at this point in time is close to around total borrowings being around 655 crores. The expectation is that the reason for this increase in the debts that we have is primarily an account of the acquisitions that we have taken during this year. We have close to around 80 odd crores in terms of the term loans that we have taken for the Telangana and the Globe acquisitions, both in terms of the term loans that we have taken. From the inventory position that you actually mentioned, the inventory levels have significantly reduced when we look at it from a 9 months period at the end of December 2025, and we are expecting these levels to come down significantly. The levels that we are really looking at is close to around 21 days in terms of the inventory, and that is the total inventory across the organization, while the new vehicles inventory has come down to close to around 18 to 19 days. Now, the forward position in terms of the exit for the inventory that we are looking at is to maintain the same level as the inventory that we had as on the exit of 31st March 2025. We would have an inventory of close to around 550 odd crores, while we have expecting a top line growth at the exit for the current financial year to go up from a 5,500 exit for 2025 to move to a 6,500, 6,600 growth, 20% growth. And with the acquisitions, we will still keep the inventories at the same 550 odd crores.
Thank you, sir. Sir, on the debt position, you mentioned that we have a long-term loan of 655 crores, right?
No, it's a mix of long-term and short-term. The major borrowings that we have on our balance sheet is an account of the vehicle loans that we have. That's the inventory funding that we have. We have term loans that we have taken for the acquisitions that we've actually made. The term loans that we have in our balance sheet is close to around 80 crores.
Term loan 80 crores and total debt of 655 excluding that term loan.
Okay. No, that's including the term loan.
Including, and do we expect it to further rise because we have to make some payment for the subsidiary, or it will be done by cash flow from operations?
No, we don't expect the borrowings to go up. As Naveen mentioned, we are more in a consolidation phase in terms of what we have been doing. The inventory levels are expected to come down, and so the borrowings also will not go up.
Yeah. No, I think you've shown only 47 crores in term loan of 50. The remaining is lying in.
Yeah. So the remaining is that. So there is the borrowings that we really need to pay out. So that's the reason it is actually sitting in the current.
Okay. So we expect to close March 26 around 650 crores, same level of this debt.
Same level of, yes.
No, not 650.
550 crores.
550 crores in terms of working capital debt, which is the same as FY25. So I mean, a rough cal would be in terms of 6,600 crores. We would, if you look at 12 months as a 1 month inventory is about 500 crores. But we would be close, we'd be close to that. In fact, it will be slightly lower in terms of inventory on that. Closing inventory.
Got it, sir. Sir, my next question would be on the line of Audi business which we have acquired. What kind of margin do we expect from that business in gross margin as well as EBITDA margin in both the business, service as well as sales?
Yeah, so it will be quite similar to a Jaguar Land Rover business. Only thing is it will take a little more time for that business to kick off. This quarter it would be probably negative in terms of, because we've just kicked off that business in January. February onwards we'll probably start selling vehicles. And Audi as such, the volumes are quite low right now. So the first 6 months, I think the margins in sales would be slightly lower. In terms of service margin, we expect the same service margins as a Jaguar Land Rover business.
Got it, sir. I'll join back in the queue. Thank you.
Thank you, sir. The next question is from the line of Nilesh Doshi from Prospero Tree AMC. Please go ahead.
Thanks for the opportunity. Am I audible, sir?
Yes,
Yes,
sir.
yes, Nilesh. You are.
Thank you, sir. Good afternoon, sir. Sir, I am the investor since IPO, so my question may be more than the Q3 only. Sir, Popular Vehicle is a dealer for the leading OEM. The revenue of the said OEM is growing, its profit is going, but the dealer, Popular, the profit is continuously falling because the employee cost is always increasing. It is always higher than the EBITDA margin, EBITDA, not the margin, EBITDA. So in such circumstances, when even our revenue is growing, our profit is not growing. our GP margin is even in the quarter three also it is from 14% to 12%. Last quarter there was a less demand and the company is required to offer the higher discount. The quarter three is different because there was a GST cut as well as the demand was higher. OEM itself is growing. The Maruti particularly has retail sale has grown by 43%. In such circumstances, when the Popular will report the profit number which it used to report at least pre-IPO or after at least in a 1 or 2 quarter post-IPO.
Yeah, which is why I think we have given the guidance, Nilesh. I can understand the pain in that. In terms of the profit margins and the profit, we've given a guidance that FY27 we should close at least as much as FY24, which is about 76 crores PAT. So that is what we're looking.
And is there any plan to control the because company cannot generate the higher demand, but at least can control the operating cost. Say employee cost is ever increasing every quarter on quarter, and employee cost is higher than currently in the last 5 quarters. The employee cost is higher than the EBITDA. It is more than the 100 crore rupees of the employee cost. Okay, and our EBITDA is around 50 to 60 crore rupees. Even in this quarter also it is around 60 crore rupees. So when the shareholder will be rewarded, because you are generous, you are offering the higher salary, everything to the employee. But what about the shareholder? Because we feel the pain because in last 5 quarters we were not rewarded and the stock price has come down. No, we understand that stock price is not in the control of the company, but at least the operating cost can be controlled, sir.
Yes, and that's why we're giving the guidance for FY27 that we will be back in terms of FY24 numbers, both in terms of profitability and in terms of EBITDA margins.
Okay, sir, that's good. If it happens, we will be happy. Because the another question is related to the after-sale service, because the after-sale service is a business which contributes the less number in revenue, but very high profitable margin as well as high profit generating business. And in this quarter, the volume is degrown from particularly in the PV segment. So what has happened? Because no doubt the Honda dealership, we have exited from the Honda dealership, but I think we are selling the higher number of Maruti cars. So that number should not be suffered that much. What happened and how look at after-sale service business will grow?
Yeah, so in terms of the after-sale business, we had expected a 2% in terms of the organic growth and about 5 to 6% in terms of acquisitions. Unfortunately, the organic growth has not happened. Q4, we would look at by end of FY26, we would look at a flat over FY25. But FY27, we should see an increase of about 10 to 12%, including whatever the acquisitions that have already been done, which is in Telangana and Punjab. So that we should be back on track, which is why we're giving the guidance in terms of the profitability also.
And so
in terms of service value, just to add, in terms of service value, though the numbers have dropped, in terms of service value, we are higher by about 1%, but we expect that service value numbers would grow further because the ASP has gone up by about 11 to 12%. So combine that with about 8 to 9% total growth next year, we'll see a much higher in terms of service revenues.
In such circumstances, if the volume will also grow, then there will be the much more higher profitability because I'm sorry. Okay, sir. Sir, is there any specific reason for the degrowth in the GP margin from quarter 2 to quarter 3 on a quarter-on-quarter basis, though the revenue has grown? Are we still offering the higher discount to clear the inventory, or is there anything revenue mix or anything particularly any change happen in the quarter 3?
So, Nilesh, just to answer the question, yes, there has been a drop in terms of the gross margin. And from the previous conversations that we had at Naveen's presentation, there has been a change in the revenue mix that has happened, both for the Maruti. As the GST cuts happened, it encouraged the smaller car sales. So the volume in the smaller cars has actually increased, which comes at a lower margin. That is for the Maruti standalone. When we look at the second part, we also spoke about the commercial vehicle business and the Ather businesses have actually outgrown in terms of the total numbers. So when we look at the total mix on the 4,400 odd crores that we have done, and even for this quarter, the total mix on the commercial businesses and the other businesses that we have has gone more than what the total is, because of which the margin percentages have actually reduced. But having said that, those all have added to the bottom line. There has been quite a number of corrections that have been taken care in the current quarters. Inventory levels have actually dropped significantly. Lower inventory levels means lower discount into the next year. It also means lower in terms of the interest cost. Yes, we should be actually seeing a turnaround in terms of the profits that we are expecting to see. And the more importantly, the services business also will actually have the upside coming in with the sales that has taken place in the current year and the last quarters. We will see positives coming out of that. Yes, there is a little bit of erosion on margins in terms of the acquisitions that we have done. But having said that, these things, all of this will be taken care of with the kind of growth that we are seeing in the other businesses. Nileshji.
Thanks. Last question, sir. Is the Maruti, there is a GP margin is different as model wise, or it's a flat margin Maruti in Maruti GP margin, or second, the CV GP margin is less than PV?
Yes. So the margins in each of these Marutis are different from vehicle to vehicle. It is lower at the arena scale, and as the vehicle price goes up, the values actually increase. Similarly, when we do a comparison between the mix of vehicles, passenger vehicles to commercial vehicles, the commercial vehicle percentages are lower, and Ather also is significantly lower because of the value that we have. So as the mix actually changes, the gross margin percentage also is subject to a little bit of change.
Okay. Thanks from my side. Thank you.
Thank you, sir. Ladies and gentlemen, to ask a question, please press star and one now. Participants who wish to ask questions may please press star and one at this time. The next question is from the line of Preet Pitani from InCred AMC. Please go ahead.
Thank you for the follow-up question. Sir, you mentioned 1 or 2 quarters back that there is some restructuring program going on at the Popular, and it will help to increase the margin and reduce the cost. If you could brief about what programs you were talking about and why we are not seeing it. It has been 1 or 2 quarters, and we mentioned that it will be happening from second half of FY26. So why we are not seeing that? What is the probable reason? Or if we are seeing, and what is the outcome, outlook on that particular thing?
One that we talked about earlier was in terms of centralizing our entire back office. Today we have a back office in each of our showrooms. We wanted to centralize it, which will bring in, the intent is more in terms of bringing efficiencies and reduce wastages, while it does have an impact on the cost also. So that we actually wanted to kickstart it in kind of Q3 and then ended up by Q4. That was completed by Q4. That is what was the plan, but that's getting deferred by 1 quarter. Unfortunately, post-September, a lot of things that we did not think of happened, and suddenly there was a surge of demand. We had to manage that also, because with the delivery increasing, there was some bit of strain on our pre-delivery inspection and all. So that being said, we have started that now in Feb. Should be able to close it by about April or May. So early Q1, we should be able to kickstart that. There was also another conversation in terms of centralizing our entire, service marketing piece also. So this entire thing will come in across the next 2 months, so that Q1 we should be able to show proof on that.
Other than that, if you look at the ASP on the service side, that has been consciously being built up in terms of increasing the ASP value. So that's why I said we've been having 11% increase for the full year. But if you look at just Q3 to Q3, we have had close to about 17-18% increase on the ASP, which will continuously take it forward. So these are the initiatives that we are trying, which is why I said for the full year of FY27, we should have an ASP increase of about 8 to 10% at least in terms of service, and increase the volume also by about 7 to 8%.
Got it. Thank you, sir. And how much benefit it would be done in the absolute terms from that restructuring program which you are talking, that back office centralization?
On an annualized basis, it should be about closer to 1 to 1.5 crores. But more than that, it will improve that's the savings part. But it should improve our inquiry to retail conversion percentage by a good margin, and also enhance the customer satisfaction, which will flow through into further additional business in the coming year.
Got it. Sir, and second question would be on the line of Maruti. We saw that Jan wholesale numbers were not that good. The company told, domestic wholesale I'm talking, company told that the reason for the same is capacity concern. So is that the same problem we are also facing, or we are seeing a good growth in Maruti for this?
Can you repeat that question once more, please?
What was the concern that you mentioned?
They told that there is a capacity concern and that's why wholesale volumes were lower as compared to industry.
No, it is not a capacity concern.
No, so for Maruti side, it could be because in terms of the vehicles that we've asked for, we have still not got in terms of Jan. So in fact, we had a loss of sales in Jan because of non-availability of vehicles, which is continuing in Feb also. The overall numbers are higher than the previous year.
Okay, but we are seeing a dip in the Jan month in Maruti numbers.
So we didn't dip, but the expected growth did not happen.
Yeah.
Because primarily I'll tell some of the smaller cars like Espressos were not at all selling in the last 2 years. But from October onwards, there's been a huge demand and we are not getting that to the supply. Similarly, post the GST, even the entry level hatch, so not entry, premium hatch, Baleno and all, and entry level SUV Fronx has also been doing good. So there, while we had a lot of stock pressure earlier, now the demand is slightly higher than what they can supply. So, but that should get evened out by about March, April is what they're saying.
Got it. And sir, on our standalone number, we can see that in consolidated, we have been break-even by we are break-even by quarter 3, but our standalone number shows 12 crores of loss. What kind of loss we expect in quarter 4 on standalone as well as consolidated numbers?
Okay. So the loss that we actually see in the standalone for PVSL is more coming because of the acquisition that we did in Telangana. The Telangana at a PBT level, we have a huge impact that is coming in for the acquisition in terms of the index and the depreciation that's close to around 8 crores that has impacted us. If we take that out of the equation in terms of the calculation, PVSL would have actually been profitable. So that's the reason you actually see that. Having said that, from an operational profitability perspective for Telangana, we are expecting that to turn around, become operational by second quarter, H2 of 2027, 2026, we should actually see that breaking even and getting profitable. But the index impact and the depreciation impact will continue because of the leases that we have, and that would continue for another couple of years.
And what do we expect in quarter 4 of this financial year, or in both standalone as well as consolidated numbers? You can tell us EBITDA as well.
EBITDA would be, we are in standalone, we are around 3.4%. In terms of acquisition and consolidated, we'd still be around probably about 3.25, 3.3. But we're hoping that this should go up by about 0.1. We had earlier given a guidance of 4%, but we are not able to achieve that. We would be probably ending up FY26 with about 3.5% in terms of EBITDA numbers, so 3.5. In terms of overall profitability for Q4, we intend to be profitable in Q4 overall and have a FY26 at a positive note, including the Ind AS effect, the cess impact, and all that.
So we are expecting FY26 overall EBITDA margin to be 3.5% and FY27 to be 5%, and quarter 4 and FY27 both would be PAT positive for the company as a whole.
Yeah.
Yes. Thank you. I'll join back in. Thank you, sir.
Thank you, sir. The next question is from the line of Gautam Madhavan from FedEx Securities Private Limited.
Yeah.
Please go ahead.
Hi, thank you for the opportunity. Depreciation, the increase of crores, if I heard you right, is that because of the new acquisitions?
Yes. Yes,
Q3. Q3?
This is because of the acquisition in terms of the depreciation for the Telangana that we've done. The depreciation cost has gone up by close to around 4 crores. In terms of the globe also, we have an additional depreciation of around 40 to 50 lakhs for the quarter.
Got you. And just, when we think of depreciation for FY27, this would be the number that we kind of run with?
This is the number on terms of the additional acquisitions that we have done. The balance remains the same.
Got you. And also just on finance cost, if we can understand, the increase in finance costs from Q2 to Q3, inventories have sort of come down. What would be, what is sort of giving that 2 crore increase in finance cost?
Okay. The reason the inventory levels came down towards the end of the quarter, the exit that we have has come down. Our stock levels have come to 2,300, but on average for the quarter, we still had inventory. So that is the reason the interest expense that you see for the quarter is more or less flat. And of course, there is also the interest on term loans that we have taken during that period. But having said that, the impact of the interest cost benefits that we will start to see it in Q4 of 2026 and onwards.
Got you. And, sorry, when you were talking about the debt numbers, there was a little bit of disturbance. If you can just touch upon the debt numbers, what was the term loan that you mentioned? What was the, balance debt?
So the debt that we're talking, the numbers that we're talking is close to around 550 crores in terms of the debt, short and long. And the term loan that we have taken is close to around 80 crores that we have. So the short-term funding in terms of inventory will be 550 crores, and the term loans that we have will be close to around 80 crores.
Got you. Just, last question. Appreciate the... sorry.
No, Gautam, I was just going to add that 550 crores was our FY25 March number. We'll remain at the same number for working capital in FY26 March, though the top line has gone up by about 20%.
Absolutely. Got it. Just, appreciate the guidance on service, Naveen. If we can just get a little more of an understanding of, why would volumes degrow so much? And I understand, your point on the sales and even what you mentioned in the presentation. Our understanding, at least from the previous calls, was that, as sales increase, there's obviously a backlog and theoretically, we should have just seen a degrowth. Is what my understanding was. And I understand the explanation.
Sorry to interrupt. Your voice is breaking.
Gautam, your voice broke. Couldn't hear you.
Sorry. Is this better?
Yes, sir.
Yeah.
Please go ahead.
Sorry. So I was just saying, Naveen, that we appreciate the guidance that you mentioned on service and, some of the reasons for the degrowth in service. It will be really helpful to understand why would we see a volume degrowth which is so sharp, and understand, sales have been soft for the last couple of years and there might be some tailwind, but theoretically there should still be some marginal growth in service volumes at least, right? Irrespective of the market environment maybe in the past couple of years.
Yeah. So there are two aspects to it. One is in terms of the volume degrowth. Earlier we used to do these campaigns with the service thing in terms of getting campaign numbers, monsoon campaigns and various other winter, whatever. We used to drive campaigns to summer campaigns to have AC checkup, to have wiper checkup, etc. Over this year, we have said that wherever the job card numbers are lower than about 500 rupees or 1,000 rupees in terms of job card billing, just didn't make sense occupying our manpower into that sense. So we actually reduce these campaigns. So that's one of the reasons why you see the volume dip, whereas the ASP going up by a much larger number.
Got you. And just, Naveen, so going forward, so then should we sort of assume that this right sizing of, the mix in terms of service is done and now what we'll see will be growth from next quarter onwards?
Yeah. That's why we're saying that we'll have at least about 7 to 8% growth in terms of service, both in terms of the organic growth and whatever the acquisitions that we've done. Both put together, we should see about 8%. The ASP growth will still continue to be about 8 to 10%.
Got it. Got it. That's all from us. Thank you.
Thank you, sir. The next question is from the line of Shirish Pardeshi from Motilal Oswal. Please go ahead.
And Naveen Raj, good afternoon. Thank you for the opportunity. Yeah, just quick question. Because of this acquisition, what kind of volume buildup will happen in FY27? I mean, just ballpark numbers.
So I will give you. So if you look at our Maruti acquisition in Telangana, we are averaging about 380, 400 numbers right now. For just though we took over in October, our first billings happened only by November end in terms of retail. So December and Jan we would have done an average about 380 to 400 numbers. We expect this number to be around 500 for the whole year, FY27. So about 6,000 numbers will come in from there. Bangalore, which we started off last year, April, that is FY25 beginning April. April FY26, we will see an average of about 200 to 50 numbers from Bangalore happening, which was in the region of about 50, 60 whole of last year. So these two put together, we should see about close to about 750 numbers being added in per month, which is about 9,000 numbers for the annualized basis. In terms of, so this is only for Maruti. Jaguar Land Rover we're kicking off in Nagpur this month. So we'll see about 5 to 7 numbers being added for the first 5-6 months, and then add on, and then going on to about 10 numbers from second half onward. Similarly, Audi, we should see about 5-6 numbers in terms of the first 3-4 months, and then going to about 10 to 12 numbers in terms of the Audi numbers. But these would be, in terms of turnover, would be far higher, average ticket size being 55 lakh plus.
Okay, that's helpful. My second question in terms of discounting, if discounting is at one level in October, November, December, is that level of discounting has come down in Jan, Feb, or do you think it has remained steady or it has gone up?
No, it's come down in that. So I think one of the points that both Raj and Abraham mentioned is, if you look at our exit numbers in terms of inventory in FY25 December, so December 24, I think we had carried about 3,600 numbers in terms of Maruti volume, stock units. And FY25 December, we were at around 2,000 numbers.
2,300, including Telangana.
Including Telangana, which was but if you keep aside Telangana, we were at around 1,400 numbers.
Out of which we are currently having only 700.
Yeah. So usually what happens is the discounting that continues into Jan, Feb, March is because of the inventory that you carry in December. We are not carrying that inventory in December 25. So the discounting levels for this quarter has come down now. This quarter also. And for future quarters, that's April, May, June also.
That's really helpful. Just last question. You mentioned that there is a supply shortage in Jan, Feb. So can you give a little more color? Which model or which segment, or what is the level of inquiries and order booking which you are having at hand now?
If you look at the lowest category like espresso, we have bookings in hand is about 150 to 200 bookings in hand just in Kerala. If you take Andhra and Telangana, Bangalore and Chennai put together, will be closer to about 250, 300 bookings. We would probably end up getting probably about 50 cars of espresso. That's at the lower end. So if you take segment-wise, Tourist, Model, Swift, and each of these segments, we are at a much lower number in terms of wholesale than our current demand is. There are some vehicles which are slow moving, which is there. So overall, which is why the inventory levels, new car inventory levels in Maruti, if you look at a 3-month, that is Jan, Feb, March quarter, and look at December end numbers in terms of stock or Jan opening stock, we would be probably at around 21, 22 days of inventory.
So the reason why I was asking Naveen, see, this GST cut has really benefited the automotive sector a big way. But do you think this normalization of demand will happen by Q1, or you think there will be some backlog will still continue in Q2 also next year?
I think for the whole year it will continue. The reason is not just because of the automotive cut of 10%. So there's an equivalent because your road tax is on top of these numbers, etc. So the savings are much higher. That is one aspect of it. But more importantly, if you look at for a common, if you look at people buying the espresso, the Alto, the Wagoner, in terms of the EMI and the savings they're getting in other aspects. So we were just looking at, we did a study with one of the banking, in terms of just medical supplies, who of an average household, the average savings in terms of GST savings is coming to closer to about 1,000 crore rupees. So all this is adding to discretionary income of the guy. So I don't think that the demand would just be for Q1 and Q2. I think it will be a sustained demand for and coming back on, I think 7 to 8 quarters of absolutely no growth in these segments.
So technically, you're saying that if the OEM ramp up their production, there is a high likely possibility that next year we will exceed the number what we are projecting now.
Yeah.
Okay. All right. Thank you and all the best.
Thank you, sir. The next question is from the line of Vaibhav Bayani, a retail investor. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yeah.
Please go ahead.
Yeah. So, my question is related to gross profit margin. It has come down to 12.7%. And I was seeing your, past results. It has always been 15%, 14.5%. Can we expect it to move it further, from 12.7 to 14, 15% in quarter one of next year?
Vaibhav, we probably spoke this earlier. The primary reasons for this gross margin percentage actually dropping is because of the shift that has happened post GST towards the smaller vehicles. The margins that comes on the smaller vehicles are lower than what you get on the higher vehicles, the Nexa. Second is there has been a growth in the commercial vehicle space. The commercial vehicle space has got a 52% growth. The average gross margin in the total mix of a commercial vehicle and the Ather is lower when compared to the Maruti business that we have, which could be close to around 15-16%. That has contributed to it. Thirdly, the services pie has also dropped in the total mix that we have, right? And this is expected to go up. So having said that, we are expecting things to get better. Indicatively, yes, we should get in excess of 13% going forward, and then get back to the normal levels that we had at the IPO levels at 14, 15, probably in quarter one, quarter two.
So in Q4 we can expect around 13.5%.
Yes. So because we would then start seeing the benefits coming in of the Jaguar investments, the JLR that Nagpur will start kicking in, the average gross margin values are much higher. Audi should start giving us more additional numbers coming in there. So in the total pie, that would actually add up.
Okay, yeah. Okay, thank you.
And the benefits of the sales that we are doing currently will also add to the service volumes that we are having.
Okay.
So it's a combination of a number of things actually tying up to get back to those normal levels, right off.
Right. I think that's the issue, right? Because I think employee costs and other expenses, you guys have maintained it very well. But I think the issue here is GP margin. It has gone down.
There's definitely a scope to get that better. And the moment we get our gross margins better by 1 or 2%, you would actually start seeing that into your bottom line on your EBITDA and your PAT. And as we spoke earlier, inventory levels reducing has an upside for us because your discounts will come down. Discounts coming down means better gross margin for you. Then your inventory being lower means lower interest costs for us. So all of that would actually tie back to give us a better percentage at a bottom line.
Right. Yeah, I think you guys should work towards improving your GP margin, I think that's the key.
Sure.
Yeah. Okay, thank you.
Thank you, sir. The next question is from the line of Preet Pitani from InCred AMC. Please go ahead.
Thank you for giving me opportunity once again. Sir, my last question would be on the line of you mentioned that the service growth would be around 15-16% for us. I just want to know two things more. One, are we planning any other acquisition going forward apart from the acquisition which we have done? And second, on the spare parts which we have started e-commerce platform, if you could give some brief about how, if it has started, how it is going right now, and how are the margins different from what we get from the earlier one?
No, we are, as we said in terms of a guidance, we have I think in terms of acquisitions, we have done most of the acquisitions that we were targeting in terms of the states that we wanted to expand to. We would be going slow on acquisitions unless some really great opportunity comes up. We would be consolidating our business. In terms of service, what we said is that we'll have about 8% in terms of volume growth and about 8% in terms of ASP. So that is the guidance that we've given for the service growth. In terms of SpareX, the e-commerce platform, we're just testing out the platform itself. We have taken the help of Accenture in terms of setting it up. We have not yet started business. We would probably kick off business in Q1 of in FY27.
Got it. And what kind of growth do we expect in the sales of new vehicle and also in sales of used vehicle on base of FY26?
On the FY27?
Yeah. On the base of FY26, what kind of growth we expect in FY27?
So overall, as I said, just from the acquisition that we've done, we should be close to about 9,000 vehicles. 9,000 odd vehicles in terms of growth. This year we would close at around 45,000 vehicles. So that also would be a 20% growth in terms of just the acquisition turning out. We would see a nominal growth of about at least 7 to 8% in terms of the what our existing stores are. So we're looking at close to about 11,000 to 12,000 odd vehicles being added from the base of 45,000. So about closer to about 20% growth is what we're targeting.
We are targeting 45,000 vehicles for FY26 and then 20% growth, 9,000 new vehicles from the acquisition, 9,000 vehicles from acquisition, plus 7 to 8% growth for the base business, right?
Yes. Yes.
Okay. Thank you, sir. That's it.
Thank you, sir. The next question is from the line of Nilesh Doshi from Prospero Tree AMC. Please go ahead.
Thanks for the opportunity, sir. Sir, just inform that there is a GP margin difference on the model wise, as well as the CV margin is less than the PV margin, particularly the GP is concerned. So is it the similar for the after sales service business also? There is a CV is less remunerative than the PV and the luxury is more remunerative than the other model. And in the particularly Maruti, there are the car of 5 lakhs to around 25 to 30 lakhs rupees. So it is the price wise, the GP margin, EBITDA or GP margin in after sales also?
So in terms of commercial vehicle, yes, the GP margins are lower than the passenger vehicle in terms of service. Similarly for two-wheelers. But if you look at the Maruti or the JLR portfolio, in terms of EBITDA margins across the platform is quite similar. But if you look at Nexa vehicles vis-a-vis Arena vehicles in Maruti, there's a higher in terms of per job card value in terms of about 5 to 7%. Because of the value of the vehicle. Gross margin percentages for most of the vehicles are similar, but absolute margins are different.
Okay. So margin, the percentage wise it is similar, but the absolute number may be different because of the ASP or particular model. Is it right?
Yeah.
Okay.
Yes.
So the second question is so particularly in the quarter 3, we have sold around 10,400 vehicle in the PV. Can we assume number will increase in the quarter 4 for the after sales business, at least by 10,000 the after sales business must grow because every OEM is offering the certain number of free services and generally the buyer of the car will go to the particular service center, particularly from which the dealer from which they have bought. So can we assume that by 10,000 number the service business must grow? Particularly in the PV, it is mentioned in the quarter 3 that the 10,000 number of vehicles were sold.
Yeah, so in terms of free services, that number will show up. So the number in terms of total numbers, 10,000 numbers would come in for free services. But if you look at quarter 3 of last year, we sold about 7,000 odd numbers. So the increase in terms of free services would be about 3,000 numbers.
So the net, it will not increase. You want to say that suppose 1,72,000 numbers were serviced in PV segment for the quarter 3, and we assume that in the quarter 4 it must be reported at least 1,80,000 plus number. So is it not correct understanding?
No. That 1,80,000 will happen, but what Naveen was talking about is compared to Q4 of last year, the growth. Because last year also we would have sold about closer to 6,800, 7,000 cars. The incremental volume compared to last year Q4 will be only 3,000.
That's on terms of free services, since you pointed out in terms of free services of 10,000 cars. But overall numbers, yes, what you said is correct.
Okay. And sir, we generally track because we can't ask the dealer to what number of cars they have sold, but we generally track the Vahan portal where every OEM is registered and the number of cars sold, retail sales are registered. So the Vahan portal shows that the December quarter Maruti has sold 43%. There is a growth of 43%. Can we, anytime we compare our sales with the OEM sales, are we performing better in terms of the OEM sales growth or in line with the OEM sales growth? What is our standing as on today? Because the quarter 3, particularly quarter 3, Maruti has reported 43% vehicle, more vehicles sold in quarter 3 compared to quarter 2. So what is our status, sir?
So we have also grown at 46%. So in terms of whatever has been the Maruti growth, we have also grown in the same level, say plus 1 or 2%.
That's great. That's great. Thank you. That's all from my side. All the best, sir.
Thank you.
Thank you, sir. The next question is from the line of Rohan Dedia, an individual investor. Please go ahead.
Hi, sir. Thank you for this opportunity. I had 2 questions. The first question was, in the last call, we had said that our interest cost would come down by half, but that did not happen in this quarter. So, sir, could you explain where our guidance went little off?
So the reason the interest cost did not come down is primarily 2 reasons here. One is the GST. The GST announcement came around the 15th of August. Then there was a slowdown in terms of the sale. By the time the pickup actually happened, we had already been sitting on those stocks, and then there was fresh stocks that Maruti had actually supplied to us, which added up to us because they were also piling up the stocks. And that the benefit of that did not flow through, and the sale happened in October, November, December, and our stock levels have reduced in the exit. So the average stock that we've been holding opening during the month has been on the higher side, while the month-end numbers have reduced significantly. Secondly, in your interest cost that you actually see, there's also a part of the term loans that we've taken. There's an interest cost associated to that that's getting paid. So those have contributed to those costs. But having said that, inventory reduction will reduce my interest cost, but the term loan part of it will continue to be there in the books. But there will be a significant reduction in that.
So we were holding an average of, say, Q2 mid and end of Q2, we were holding an inventory of about 80 or some days on 90 days also. That is what has come down to 24 days. So there will be a significant reduction in the interest cost.
Got it, sir. Thank you. And so my last question is, sir, there was an announcement from the company in December 25 that one of the directors from Banyan Tree had resigned. So could you share some context around this?
So Banyan Tree is a private equity investor. So he was a nominee director from Banyan Tree. So Banyan Tree has been on a board from 2018 onwards. So when we did the IPO in 2024, at that point of time, they wanted to exit the board, but we wanted their guidance over the next few years. So they said they'll remain on board. They have a lot of investments that are going into an IPO stage. So Rakesh excused himself because he said the last, I think, in terms of board meetings, he missed out 2 board meetings. He said this year would be tough for him to attend board meetings. So he stepped off the board, but we are in constant touch in terms of whatever guidance that they want to give us. They still continue to hold 10% of the company.
Got it, sir. Thank you.
Thank you, sir. The next question is from the line of Jared James, an individual investor. Please go ahead.
Hi, sir. Am I audible?
Yes, Jared.
Hi, sir. Thanks for the opportunity. My question is this. Currently, PVSL is ICE-heavy business since they rely on the service of internal combustion engine mainly for revenue generation, right? So if the market is moving to electric vehicles, how PVSL is planning to manage the transition? Is there any roadmap for the transition or any spend on employee upskilling for servicing electric vehicles like e-Vitara?
So I'll take the second question first. In terms of training of all our people in terms of the e-Vitara service, that's already being done. Even in Jaguar Land Rover, when they launched the I-Pace, which was an electric vehicle, that was also done in terms of the entire Jaguar Land Rover service team. So that training continuously goes on. In terms of preparedness of roadmap, if you look at, and we sell Ather vehicles, which is fully EVs, and we're servicing close to about 4,000 vehicles a month in terms of Ather EVs. So that, in terms of experience, that is being done. In terms of the roadmap, if you look at it, the EV penetration in four-wheelers, even today is quite low. Only the southern states and Maharashtra have a much higher EV penetration of closer to about 8-10%. But if you look at overall India, the penetration is still below 5%. And the growth, the guideline that was given by the government is about 30% by 2030. So the transition in terms of vehicles, that's new vehicle sales. But if you look at the car park, it will still be skewed towards 80-85% or closer to 90% in terms of ICE vehicles. ICE, which includes hybrid also.
And just to add on a point, in terms of our readiness, all our service centers are currently ready with the charging infrastructure. And I think barring one showroom, all our Nexa showrooms are also ready with the charging infrastructure.
Okay, sir, got it. Thanks.
Thank you, sir. As there are no further questions from the participants, I now hand the conference over to Mr. Naveen Philip for closing comments. Thank you, and over to you, sir.
So thank you, everybody, for participating in our earnings call. Looking forward to Q4 and meeting up with you all. Thank you.
Thank you, sir. On behalf of Popular Vehicles and Services Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.